AT&T has just reported its earnings in the pre-market. It is down currently 2.5%. It has been fluctuating down almost 5 to 6%. Let's take a look. Is it undervalued? Is it a buy now? As always, we'll run into a deep dive looking at their top line revenue. How well has it progressed? How well is their bottom line net income doing? We'll have a quick look at the health of the company, total cash versus total debt. We'll also see how well they're performing on a total return versus some of their competitors over the last 5 years. We'll analyze some institutional ownership in the most recent quarter. Are they buying or selling? We'll take a look at some insider buying and selling. Do we have any? And we'll also see the dividend safety. What is that score? What does it show us? As well as looking at some financial metrics. We'll also dissect the earnings that did just get released very recently. And as always, we will run them through the valuation model, getting to the intrinsic value based on this earnings, looking at the acceptable buy price given our investor margin of safety. And as always, we will take a look and see what Wall Street are forecasting for T over the next 12 months. So let's jump straight into their earnings firstly. So we can see the headline for 2024, they did miss, but Q4 wireless subscribers adds top views. So let's go into it. Now, we can see they did report before the market opening with their earnings for the December quarter falling 11% to 54 cents. So they did in fact miss on the EPS. However, we do see that their revenue continuing operations is up 2.2%. And we can see that this analyst had projected around 56 cents of revenue. And a year earlier, if we are looking at historical performance, they did have around 61 cents. So it is coming in lower. Now, on a more positive note, we can see that their Q4 free cash flow of 6.4 billion came in significantly higher than estimates of 6.07 billion. And that, as we can see here, does support that growth in their dividend, which we are yet to wait and see. In terms of their wireless subscriber additions, which is quite important, we can see it is above estimates, and they said they've added 526,000 postpaid wireless customer phones, although when we compare that to the previous year, it is down from 656,000. But the positive to note here is that analysts had estimated 494,000, so AT&T did beat on both the free cash flow estimate as well as the wireless subscriber additions. So a few things to dissect there. Now, in terms of their historical performance, they are down 10% over the last year. They're now trading in the mid to lower end of the 52-week range. Forward P sitting around 7, with that yield after today's drop going ever so close to 7%. Over the last 10 years, well, no surprise, you would be down 32% on your position. Do bear in mind this doesn't include those dividends reinvested. And we can see all-time highs pretty much going all the way back to 2016 at around $33. Now, in terms of their top-line revenue over the last 5 years, now it is important to bear in mind that some of this will be slightly skewed due to the fact they did have that Warner Bros. Spin-off. But what we can see in December 2018, their top line went from 171 billion to 121 billion in 2022. And they are expecting, as we did see, an increase to 2023 at around 122 billion. So yes, it is understandable that it has gone down due to this spin-off, but even from 2021, we can see it did drop to 2022 with a very small increase in 2023. So we will discuss this shortly when we do look at those financial metrics, those increases year on year to the top line. Bottom line net income, or 19.4 billion in December 2018. A loss reported of 8.5 billion in 2022 and an expected even bigger loss in 2023. So just a few things to point out. Very inconsistent, not just on the top line, but also the bottom line. And we have 2 years of a net loss showed in their accounting statements over the last 5 years. So something just to consider. It isn't all doom and gloom, as there was some of that relating to the spin-off of Warner Bros. Now, in terms of the balance sheet, a quick health check, total cash versus total debt. 5.2 billion of cash and short-term investments in 2018, 7.6 billion in their latest quarterly report. So they are holding more cash than they did 5 years ago. Now, comparing that numerically and directionally to their total debt, what we can see here is that it has gone from 179 billion in 2018 to around 163 billion. So on a more positive note, whilst the cash has increased, their total debt, which was humongous in 2018, has started to come down, moving in the right direction, and we'll touch upon this when we do look at the net debt to EBITDA metric and analysing the dividend safety. So very briefly then, companies in a similar sector, we have Deutsche Telekom, we have Verizon, we have BCE, and a few other popular ones to note. Now, over the last year, including those dividends reinvested, AT&T was one of the worst performing, as we can see. If you want to compare them to one of their direct competitors, Verizon, in the same year, they were up 14.5%. Now, when we look at the last 5 years, we can see that AT&T is up really only 2.4%, the second worst performing. And when we compare that to Verizon, in fact, Verizon is the worst performing, so they actually switch in terms of performance. But as always, just because these are very bad performers, such as AT&T, it doesn't mean that their historical performance is any indicator of future performance, but we do include it within our analysis. Now, institutional ownership for T around 54%, 6.2 billion worth of sales by these institutions over the last 12 months, 4 times as much buying, 24 billion over the same period. Institutions are liking AT&T. Clearly, they have been buying a lot of shares, with the largest in Q2 of 2023, but we also note in Q1 and Q3 more buying than selling. With Q4, we see the opposite. We see slightly more selling than buying. But overall, over the 2023 period, institutions have been buying more shares than selling. But as always, do your own due diligence. Don't copy what the institutions do blindly at all. Insider selling or buying, we have had a very quick look. We filtered for AT&T with a minimum 100 shares over the last year, and we can see there has been no insider buying or selling, so we will skip that and go straight into the financial metrics. Dividend safety score then 60, it is sitting borderline safe. Market cap 123 billion, a mega cap company. Now, in terms of those key recessionary metrics, while they increased the dividend during the last recession, they had above average growth of negative 1% versus the S&P's negative 12%, and they also outperformed the S&P with a negative 45% return versus the S&P's negative 55%. In terms of dividend growth, well, no surprise, no increase last year. They did in fact have a dividend cut, hence the negative 11%. The last 20 years, again, 0% on average, although we do know they have started to increase those free cash flows, which is very positive and could mean the start of those nice increases from AT&T. Dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. Now, 2 things to note here. It is below, so that is an overvaluation signal, but given the share price is essentially dropping by at least 2 to 3% right now, it could go down further, so I would expect this 5-year, or in fact this current yield, to go slightly higher, so I would expect a reasonable valuation upon market opening. And the forward PE I would expect to go lower, and we can see a 7.1 right now based on the current pre-market value versus the 5-year average of 8.5. We can also see the communication sector be significantly high at 16.6 versus AT&T 7.1. Free cash flow payout, this is very important. Earnings, it is susceptible to manipulation by management through accounting, so we do tend to just ignore it, but the data is there for investors who like to use it. Below 70% for the telecoms industry. Now, 2022 at 64%, 2023 expected 40%. I would like to see, especially today, given that free cash flow has increased from the analyst estimates, at least a few percentage point increase to the dividend. It would be nice to see, in my opinion, a 4% in line with inflation increase. Free cash flow per share, 253 in 2013, 173 in 2022. So we do see a lot of inconsistencies. Up to 2021, it was moving in the right direction. Now it has dropped in 2022. It is expected to increase to 276. So it is moving in the right direction, but you can see the inconsistencies with this company, which is a bit of a worry. But as always, it is important to understand the type of companies you are investing in. Now we can see here the drop in their top line. Now again, this is due to the spin-off with Warner Discovery, and therefore it makes complete sense. Now 2023, we can see a 1% increase. Not the greatest. In fact, when we did look at the reported quarterly earnings, it was up around 2%. As always, I do like to be around 2 or 3 to 7% for steady moderate growth. So what we can see in 2023, their top line in real terms, considering inflation, actually decreased. Always bear that in mind when you do analyze companies. Always factor in inflation. Total sales then we can see 129 billion to 122. On top of that, one thing they do that I really don't like is the opposite of those share buybacks. They issue shares, so they do the opposite of returning excess cash to investor pockets. They dilute your position. 5.39 billion shares in 2013, 7.17 in 2023. ROIC, remember what we're looking for in my personal opinion is 10% or more. The reason for this, it gives me faith that management are able to effectively allocate their capital. What we can see here, it has been pretty much below 10% consistently, although 9% in 2022 and 8% in 2023 isn't the worst, and probably if this was something I was looking to invest in, it would be the absolute bare minimum. Operating margin, very nice to see, above the minimum 14% over the last pretty much 8 years. And the same for the free cash flow, although that has been above the minimum over the last 10 years. So that is very strong. 2023 is expected to be some good free cash flow margin. As we saw in the earnings, that free cash flow is higher than analyst expectations. Net debt to EBITDA, now remember this is the earnings before interest, tax, depreciation, amortization. Shows us the strength of the company's balance sheet and the dividend safety. Below 3.5, this is the number of years it would take the company to pay off all of their debt net of cash on hand. 2023 at 3.23 is looking more positive, but bear in mind it is straddling around that maximum that we look for. So just something to keep in mind, in my opinion, if I was an investor. But so far, from what we can see with the net debt to EBITDA below 3.5 and the free cash flow payout below 70%, that dividend does look to be safe for now. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we just jump into the valuation model, just to let you know, we have sent out our first free weekly newsletter every Sunday. So last Sunday, we did an article on the 7 golden dividend metrics, talking about our screener for picking undervalued stocks. If you do want to read that, click on that free pinned comment below, and we will be discussing some undervalued stocks in the upcoming weeks. So now let's jump into the valuation model. Now, typically the first model is Graham's valuation. However, given the trailing 12 months earnings per share for AT&T is negative $1.51, this model won't be relevant. And the same really applies for the next model, given we are starting off with AT&T's negative 1.51. And in my opinion, the only real comparable company is Verizon. So let's start off with the first model we're using, the dividend discount model. Now we see that dividend cut last year. Average growth at 8%. Now before that we were seeing increases of around 2%, so I have gone for that forward looking. This gives an intrinsic value of $19 above the market value of $16.62. Bearing in mind this will move a lot today given it hasn't opened yet or in terms of the market. Discounted cash flow model, my favorite model. We have the free cash flows year on year, average growth per analyst. Average growth at 5.39, analyst estimates around 4%, so we have gone a lot more conservative. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get an intrinsic value of $21, so we do have a double sign of undervaluation in this calculation. As always, if you do want to grab a copy of this model to run through your own companies to get to your own intrinsic value, as well as your own acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. So margin of safety that we always start off with is 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. If you believe that with AT&T or you're satisfied with a 10% margin of safety, $18 would be your acceptable buy. At 15%, $17. At 20%, pretty much not just at the current price, but who knows, with today's fall, you could be looking at a 20% margin of safety. So right now, we're sitting at a 15%. In terms of Wall Street, well, they see around 20% upside over the next 12 months and a price target of $20.70. Now, personally, this isn't one that I will be looking to invest in. There is a ton of debt, and in terms of the future, I believe there are a significant number of opportunities out there that will completely outperform AT&T in the long run. But as always, everyone has a different reason for investing. Some people will like this yield, which will be coming close to 7%. But the only thing I would say is always bear in mind that total return. Yes, if the dividends are good, but your total share allocation or your capital allocation is decreasing, it isn't that great when you can be investing in companies where both the dividend increases in double digits as well as your capital allocation increasing significantly year over year. As always though, do let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit the subscribe and bell button, and as always, I'll catch you on the next one. Take care for now.